Good morning and welcome to the Post-Monetary Policy Committee press briefing. This is a briefing hosted by the Governor of the Central Bank of Kenya after the Monetary Policy Committee meeting that was held yesterday. Today is March the 30th, 2022. The MPC held its meeting yesterday, which is the 29th of March, 2022. As is usual, the Governor will go through his statement without interruption, and we shall then come back to a session where we can have a question and answer part. If you want to ask your questions, please do so via Slido. That's www.slido.com. The meeting code is MPC 0322. MPC 0322. Without further ado, I'd like to welcome the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge.
Thank you. Good morning. Welcome again to this briefing following our MPC meeting yesterday. When we last met, who would have predicted the current external conjuncture? The COVID pandemic appears to be abating, but of course with significant scarring of the population and indeed of our various systems. A major war is taking place in Europe, and prospects of even a world war, sliding into a world war, are quite real. Record high oil prices and other commodities in the global market. Record high inflation in the major economies, something that hasn't been seen in more than 30 years in some cases, and indeed, more than 30 years in some cases. And let's not forget the ravages of climate change. All these things have become much more present than they were just a mere 2 months ago when we last met. In the course of this briefing, I'll inform you how the MPC yesterday looked at this conjuncture and how we ended up coming up with how we ended up at the decision that we made. And I'm sure you've already seen the communique, the press release that was issued last night covering the decision, but indeed also covering the background to it. First off is the global developments. Over the last 2 months, we have witnessed a dramatic worsening of the global outlook, a change in the balance of risks, and a reevaluation of the policy choices in the advanced economies. First off, vaccination progresses, including in Kenya. And there's the usual slide that we have been showing you. And you can see there has been progress. But I think even in Kenya, fully vaccinated, 8.9, and even about more than 250,000 people have received booster doses, booster shots, and total vaccinations are at 12 million. So this is progressing at pace, and of course we again continue to encourage everybody to remind everyone else that they're in touch with to get the vaccines. It is important to be vaccinated in order for all of us to be safe. That is one thing, but I think at the same time we have had travel bans and restrictions have been lifted, and I think we are, in a sense, easing towards normalcy or some semblance of normalcy, even though the normalcy may not be where we started off back in 2020. There are still lingering concerns about a resurgence of the COVID, an outbreak of COVID again, in whichever form, in terms of, let's say, the various variants, as we have seen also in China. So that issue still remains on the table, and therefore it calls for caution in terms of the way we approach the various measures, protective measures that we still have in place. Secondly, all benchmarks of oil prices oil prices have posted all-time record highs. So Marban is this slide that we are showing you, Marban oil, and again, this is our benchmark oil here in Kenya. And you can see for several years, actually since 2021, we started off quite low. As a matter of fact, even before that, back in April of 2020, it was at $20 a barrel. That was sort of like the bottom, $20 a barrel, from $60 a barrel in 2019, an average of about $60 a barrel in 2019. And you can see how this sort of developed, how the price of oil, Marban crude oil, rose. And at December 2021, it was at $79 a barrel. And you can see after that, it has shot up to a peak of $130 a barrel, and has since moderated. In this slide, we are showing it at 112, but actually yesterday, it was $110.06 per barrel. It's still north of $100 a barrel. So even though it has come down from 130, it's still very high relative to what it used to be, etc. So this is obviously a cause of concern. Thirdly, we have the Russia-Ukraine war. Aside from the war itself, the question we have is, what is the impact on our economy? I think first we have to appreciate the devastating, let's say, how devastating the war is for the citizens of Ukraine and the refugees. We've seen those photos of refugees trying to cross into the neighboring countries, etc. That obviously is distressing for all of us. But coming closer home in terms of the economic impact, I think the first one is that the prospects, which were very real, prospects of expanding tourism, by having more travelers or more tourists from Ukraine and Russia. As a matter of fact, they had already had some charter flights that were coming into Mombasa from the Ukraine. Now, all those prospects have been put on hold, understandably so. Then, of course, you have the merchandise trade. And the slides that you have before you, first and foremost, Russia and Ukraine are among the top 5 global exporters of, let's say, cereals, grain, and oilseed. I particularly like the sunflower oil and the color of if you remember, the color of the Ukrainian flag is that yellow sunflower. I mean, it's related to the sunflower. So that is actually their national flower. But anyway, so let's begin with the others. I think the ones that matter to us, of course, are wheat. And you can see the impact. A lot of wheat is imported, or rather share of wheat trade in the global markets from Russia is 24% and Ukraine 10%. So that is 34% already. Sunflower oil, as you can see, they really dominate, almost 75%. And another commodities which are not here, this is only grain, obviously impact on the oil market, and importantly on the gas exports to the European destinations, Germany, etc. The next slide shows the share of wheat exports for selected countries. And I think here you can see Kenya. Kenya is about 43, 44%. So this is the share of wheat exports, wheat imports that we get, and how much of that is from these two countries. So almost half of our imports, 44%, really is from those two countries, and therefore it will cause some impact on our imports of wheats until we can, let's say, redirect our our sources to different countries such as Argentina and other countries that are obviously dominant in terms of wheat exports. The next one is obviously the impact on the global food prices. And I think this is the first one, of course, is grain. This is an index that is done by the UNCTAD, and basically just look at the direction. The grain prices, or the index of the price of grain, has surged in the recent period this year, and that's the peak towards the end, and the others as well, other commodities and indeed also agriculture. So this is something that shows you that it is of concern to us and also other countries. It's important, and I'm sorry to belabor this, to also understand how important this, let's say, trade with Russia and Ukraine. So exports to Russia and Ukraine in 2021 accounted for about 1.4% and 0.1% respectively, so total 1.5% of total Kenyan exports. And if you look at the composition of that, tea was dominant. So you can say that actually in terms of tea and cut flowers were really the significant exports to those countries, representing 50% in either case and about 25% in the case of cut flowers. The other thing, of course, is the question about the imports. What are we doing on the import side? And you can see in terms of imports, they accounted for, again, about 3%. 3% of total Kenyan imports, and Russia was 1.8 and 0.9 was Ukraine. And the composition of imports from Russia, wheat dominates. So of that 1.8, about half of it was accounted for by wheat imports, that is Kenyan imports. And in the case of Ukraine as well, you can see about 75% of that is wheat. So wheat obviously dominates in terms of the imports. Then I think so. I guess the summary of that is, even though they are dominant, we have significant trade sort of possibilities. We had significant trade possibilities with those countries. I think wheat is a concern, but again, in terms of numbers, it's not so dominant, and hopefully that can be redirected or sourced from other countries that are in the wheat market. Now we move on to other things, and I want to remind ourselves that indeed supply chain problems remain. So we talked about this last time. There are supply chain problems, and those will remain until they are dealt with. Then we have inflation. Inflation has become significant in the advanced economies. You have a slide there that shows the developments, but I think it is more important to look at it towards the end. For instance, the US, the United States, last print was at 7.9% in February, which was a 40-year high. And this is expected to actually surge towards double digits and could be in the double digits sometime, post-July, sometime in their summer. The UK, the inflation, the CPI inflation, in February was 6.2%. 6.2%, which is a 30-year high. And indeed, in the Eurozone, all-time high of 5.8%. And all this these numbers have not fully incorporated the energy price increases that have been seen, say, in the last month. So we expect to see these numbers to rise. That's the print, the CPI outcomes or the inflation outcomes in those economies, the advanced economies, to continue to rise. So it offers the authorities in those countries, obviously, different policy choices from the ones that they had, say, 2 months ago, back in January, or even for that matter towards the end of 2021. And the policy choices, or should we say the policies that are being considered, I think the first of this is fuel price subsidies that for pump prices, and indeed more generally fuel prices. You can think of gas in the European destinations, etc. So this really direct relief measures, fuel price subsidies, and they are not only being considered, they've been put in place. And, for instance, from Australia to Germany, from the UK to the US, all these countries have had to take steps to actually, in some sense, protect their population from the increased prices that are being forecasted, or should we say, being seen in those economies. Secondly, diplomatic pressures have been brought to bear on the producing countries, the oil-producing economies, so as to maintain, indeed lower the prices. And we know that this will continue. As a matter of fact, just now there's the OPEC meeting this week, but obviously we don't know what the outcomes are of those meetings. But we continue, and again, we do understand it's not just a one-meeting solution. It probably will take a bit more time and consideration by all concerned. Thirdly, monetary policy. Last year, there was a lot of conversations about, let's say, the tapering of quantitative easing and whether inflation was temporary, etc., or transitory. I think all those conversations have just gone out the window. And what is clear now is that all these economies are ramping up the interest rates in short order. And this, in my view, is the equivalent of stomping on the brakes, doing a handbrake turn. And you can imagine there are consequences for that. Some that could be quite dire, particularly for the most vulnerable. So in some sense, we do understand their policy choices, and we appreciate their difficult policy choices. Bottom line, there are significant risks of policy mistakes and also financial market turmoil as we go ahead over the next month or two. But I think here is where we need to watch this space carefully. And of course, encourage our counterparts in those economies to really work hard to lower let's say, the price of oil in the global market. Secondly, we are still waiting for revised forecasts that is on the global outlook and global growth, which will certainly scale down the growth prospects in 2022. The IMF is expected to issue their view forecast in the next couple of weeks, I believe, and so we are waiting for that. So let me switch then to the domestic economy, and the first item here is obviously inflation. We have, you already have seen these numbers, the February outcomes. The overall number was at 5.1, and I think you can see first on the blue, which is the food inflation, that had come down to 8.7, and fuel inflation has come down to 6, I believe it's 6.5. And non-food, non-fuel remains well below 3%. It's at 2%. And we expect to see the March numbers tomorrow. And our expectation is that That will be along the same as February, meaning give or take, let's say, 1 or 2 points, 2 points. But a point here again is that the inflation remains well anchored based on, first, the food prices are expected to moderate as the rains come. And this we have seen every time when the rains come. And as you know, now it's raining, at least even here in Nairobi, even though actually out there in the food growing areas, there has been the rains arrived earlier. And anyway, so there's a lot more, there's real prospects of food prices coming down, those that were elevated because of shortages, etc. Secondly, the government measures to subsidize fuel prices. And that has been there for some time. I think the government has spoken quite loudly about this. And in a sense, they've taken that measure to subsidize the pump prices, if you want to call it that. In a sense, providing that relief to our consumers, all of us. Also appreciating that there's a significant second round effects of increases in price of fuel. It goes into many other products, not just transportation, or rather transportation, even moving of agricultural produce from the farms to, let's say, the markets. That costs fuel, etc. So it has it impacts on many other, let's say, products, and that's the second round effect that obviously would be concerned about. That said, we do understand that there would be a sticker price shock for some commodities. And this, I think, is what has happened to a lot of us. You go to a store and or kiosk or market, and you're looking for, I don't know, a particular commodity. And then the price that is there is much higher than what you have been used to. And there's that sticker price shock, and it's a real shock. But I think the point here is that it's not in every single commodity, and that's why you can say, even though the CPI is at, the inflation as measured by the CPI was at 5.1, it does appreciate that, or we do appreciate that there could be specific prices that are much higher. And it may be some of the prices that maybe you don't spend a lot of your income, your disposable income on, but it is still significant. I think the point I'm making is the point is well made. Secondly, we also know that there are unscrupulous business people, out there, and they will take advantage, or they'll seek to take advantage of any crisis. There's no crisis that they cannot take advantage of. And I think this is sad. This is really sad. And we saw this in the context of the COVID measures, right? I think you know of those very bad stories. People's lives are at stake. But yet, we had unscrupulous businessmen and businesswomen doing the unthinkable. We also saw this in the context of, let's say, importation of adulterated sugar, right? I mean, these are not folk stories for us. This is a reality for us. And I think they need to be called out on those things, because it is not an issue of pricing, it's an issue of being unscrupulous and being, well, these are crimes. And I think they need to be called for what they are. So that's what I want to say about inflation. And I want now to move to the performance of the other sectors. So this is, I guess I wasn't expecting this slide, but that's okay. That's okay. I was expecting another slide, but that's okay. So let's first, what I'm being pushed towards is doing the external sector first, and we'll do that. So here we have exports, right? We already talked about the changes that are taking place in the Ukraine, but I think overall what we have seen is exports have continued to grow as we had expected before, as we saw towards the end of 2021. And these are the 12-month values. So in each of these, you can see there has been increase, including horticulture. I think it's important to point out horticulture because the recent volumes have been lower in terms of fruits, etc. But overall, the 12-month value, you can see there's a modest growth. Then we have imports, and this is overall imports. I think there's again, they have, I think the one to point out is oil imports. You can see it's significantly higher than where we were before. That is the 12th month to February of 2021 compared to 12th month February 2022. So you can see that significant increase. But also the others, so across the board, there has been increases, but oil is significant. I also want to make the point, the increase in the machinery and transport goods, that also has been significant. You can see that this is all supporting the the resurgence of growth in the economy. Another slide, this is on imports, but it is by composition, consumer goods, intermediate and capital goods. And the one I want to flag, of course, is the intermediate goods excluding oil. And you can see it's grown from 7.9 billion in the 12 months to February 2021 to 9.6 billion in the 12 months to February 2022. It shows, again, it supports, let's say, the narrative of a strong manufacturing sector and other sectors as well, but definitely manufacturing. This is we haven't shown this slide before, but I think it is important to look at it. You see, there are significant, the services sector. Quite often we look at the tourism sector or tourism earnings. But in effect, there are other elements in the services sector or the services elements in the balance of payments. And so here you have the various components of them. So for instance, on transport, that's the, I guess that's the orange line. Now don't ask me whether the colors are orange or not, but anyway, that's orange. And then you have the other components, travel, which we understand, that's the silver one, has been picking up. You can see all the way from April of 2021, these are growth rates. So since April 2021, there's a sort of significant reversal, improving pickup, as it were. And that has continued. The financials as well, and indeed also ICT. ICT is surging through the roof. And that, I think, is important for us to appreciate because there's a significant, let's say, room to scale. So this can be scaled up dramatically. This is a slide that you are familiar with, which is the number of tourists arriving. And you can see in the period, the green bars, that is January and February of 2022. So we are going back to normalcy, but we are not there. And I think the prospects now are positive, and particularly also appreciating where our tourists come from. So the direction of the source economies, and the U.S. remains dominant. Europe also is significant, but I think they are now reopening, and the travel restrictions that were there before and the warnings that were there have been lifted. So the prospects in this are good. The diaspora remittances, this is something we've discussed before. Strong these 12 months. You can see compared the 12 months to 2021, significant growth. But I think what is one of the things that we need to appreciate is the seasonality. That is important. So we always see a significant increase in remittances in December, actually towards the end of the year, November, December, and January. And then it moderates, it comes down. And then it will pick up generally around April, May, Easter, and then eventually will remain high. And towards the summer, it will come down again, all the way to September, October, and then pick up again. So there's a clear seasonality if you look at the data. And we have seen that seasonality playing out, etc. But as we said before, in the context of the diaspora survey that we did, one of the elements here is that why this has increased or has improved, and why we believe that there are strong prospects of it remaining high, is that the diaspora now, or those that are sending money, have more channels which are cheaper and, for that matter, more convenient. So you can do anytime, anywhere, right? Sending money from your mobile phone, wherever you are, in the US, in the UK, etc. Next is now the overall, putting it all together, where are we? And I think this is the current account deficit that we are now projecting. It is 5.9. We are now projecting 5.9% of GDP for 2022. And really, aside from oil, the difference, we had 5.2 before. And the change to 5.9 is entirely driven by the higher oil prices that we are expecting. So if we sort of abstract from the high oil prices, we would actually be exactly where we were at 5.2% of GDP. So what does that mean then in terms of the current account? We've given you 5.9, but also it is important to see what is happening in the rest of the other elements that are related to the external sector. And I think a big issue is the foreign exchange market. First of all is what has happened to date. That is an updated slide as of March 24. And you can see the dollar has remained strong. So against a dollar index, meaning the dollar versus all other countries, major countries, you can see the dollar has appreciated by 3.2%. And most of the other, well, this is a chart that I'm sure you are familiar with. Of course, the exception at the end is Russian ruble, which had depreciated by a lot more. And now you can see it's only at 20%, which is still significant. Next slide shows coming home currencies that are closer to us. And I think you can see we are the one, we have depreciated by 1.29, 1.3%. That is in the year 2022. And you can see it matches well with the others, including those in the East African community, our neighbors. So I think we are feeling okay in terms of operating the market, whether the market has been operating correctly. There is liquidity in the market in terms of FX liquidity, and we continue to observe it, or to observe the market, so that there is proper behavior as is required in operating those markets. Okay, so now I needed a cue, so we are moving to the to the rest, that is the other sectors, performance, the real sector, as it were. I want to, before going to the slides, I want to make a few points. The first of this is that we do not have any new data in terms of the, let's say, GDP numbers from KNBS. We expect this to come in April, May, that sort of period. And they will issue them, I think, in the context of the economic survey that they are preparing. But yes, we are waiting for the final, the initial numbers for last quarter of 2021, and indeed the first numbers for all of 2021. Our numbers, our estimates for 2021 have not changed. So we are still projecting a growth estimating a growth of 8% in the context of all the numbers that we have seen so far. So that remains where it was when we explained it back in January. You can see it there. And I think we have also looked at leading indicators, and I think the leading indicators for 2022, Q1 2022, show that there is the dynamism that came into the economy towards in 2021 has remained. And that's why we are projecting growth in 2022 at 5.9, which is pretty much where we were before. So those numbers haven't changed. They've not changed, but again, the point is they've not changed because we didn't want to change them. It's because the numbers point towards significant dynamism. But I want us to go through, maybe you should show the other slide of the indicators. Yeah, this slide. So this is the other slide. Yeah, this slide shows you, I have used it before. We'll generally not show this slide, but I think it's important for you to see how things are turning out. So basically the greens are the numbers from KNBS, the quarterly numbers. And the blues are our own indicators, composite indices, composite index of economic activity. So we put in all the various indicators in the sectors, and then we have this composite index. So this is sort of our leading indicators sort of mixed together. And you can see for Q4 of 2021, we are still projecting 8.3. And for Q1 2022, we are projecting 7.3. That is the blue. And I think the point is also to show that our estimate have generally tracked the GDP numbers. There are some parts where we are beat off, particularly in Q2 of 2021. But I think the point is that this is a good, it shows credibility in terms of the indicators. Then we move to the slides that we had before. Yes, and I'll just go very quickly through this. The first, again, looking at some sectors, I'm not going to go through all of them. So the first of this is transport and storage, and then of course accommodation and food. This is important because they are really connected to the, let's say, the tourism sector. And this was one of the sectors, the hotel and tourism sector generally were lagging. You can see it still picked up. So transport and storage, that is the deep blue, 2022, the deep blue. And you can see the growth rates are 20%, 21% compared to the same month, January, February of 2021. Then and again, this is sales turnover. It is important to point that. So it is much more, it has a lot more going on in there. Then on the accommodation and food services, this is hotels, etc. Again, significant growth, 40%, 45%, and again showing that there's dynamism in those sectors. It is true in the context of the numbers at the end of the year, that is December and early January. Those obviously were pushed up by all the let's say, internal domestic tourism that we did. But it is interesting to note that that hasn't gone down in February. Basically, what has happened now is they are getting more of the conference tourism, which were not there earlier in the year, meaning in January, etc., and indeed last year. So you are getting a lot more of that, particularly in Mombasa, in Naivasha, etc. This is the 12th month. I was expecting other slides, but I think that's okay. So it's okay. It's okay. Let's go. Okay. Okay, this is credit growth in the various sectors. And I think this just shows you the idea here is just to show the significant growth rate in some of the sectors, transport and communication, trade, which obviously needs a lot of, generally, if you're thinking of the usage of credit, trade is a significant one. And also manufacturing, the growth rate has moderated, but it's still high. So you're talking 10%, 7%, etc. On consumer durables, you can see the growth rate remains significantly high, 14%, etc. So I think this is pretty much what I wanted to point at, that the indicators at this moment are strong. And the bottom line here is that we will revise our growth rates once we have the new numbers from KNBS. But at this moment, for January through, with all the indicators that we have, they point to continued growth, let's say dynamism in the economy across the sectors, etc. The one area that I would probably flag, and it isn't here, that was one of the ones I wanted to show a little more of, but it's okay, is agriculture. So there has been some mixed performance here, not surprisingly. And last year, I think we made the point that agriculture was not as strong. I think the chart that we showed just now can show that. But I think the point here is that there are mixed performance to date, largely because we expect, on the prospects, for instance, we expect the rains will provide significant lift to that sector. Most of our agriculture is rain-fed, but there's the downside, which is on the fertilizer. And our understanding is that the farmers haven't received the fertilizer. It's hard to locate fertilizer or to buy fertilizer in the various stores. So there is a concern there. And the problem, of course, is, as we know about fertilizer usage, if it is not available when the farmers are planting, it is of no use. So that is a significant risk that I think we need to watch. So those are the points I wanted to raise in terms of the growth in the economy. Now, we'll make a few points on the banking sector. I think that covers all my slides, right? Oh no, we needed to talk about the service. I'm sorry we got our slides mixed up. So I want to say a few points about the surveys. We do the 3 surveys. The first one is on the CEO survey. And we're expanding the coverage of this. So we hope that we'll get more people participating in this. And if you are a CEO out there, I encourage you to contact us so that we can actually get your views in the future. But the bottom line here is that this is just one slide of several. So we pick up this, and it shows dynamism. It shows a lot of confidence, a lot of optimism, at least as presented by the CEOs, right? So we are asking them their views. And what is clear is that the optimism that was there before has been sustained with regard to the prospects of the company and indeed also the sectoral growth. And you can see how it has moved from January to March. On the left-hand side, that is the company, and on the right-hand side is January to March in terms of the sector. So I think that is quite clear. Now, what was the source of their optimism? And the first is the favorable weather in agriculture and other things, infrastructure spending, competitiveness, and the recovery of COVID-19. This is important, and we had seen it last time. We had seen it in January when we did this survey as well. And of course, other elements of Kenyans' resilience. The concerns that they raised is obviously the higher commodity prices, and this has been coming through. And there's a slide I'll show in a minute. And indeed, these supply chain disruptions. And, you know, think about even transporting things here. You know, importing of a 40-foot container or packaging material, etc. Those prices have gone up significantly. And we are caught, in some sense, we are collateral damage in the global economy because we are small and we cannot really be, we are price takers in the global economy. Of course, there's a lot of optimism in the Kenyan and global economies, which has been dampened by concerns of the Russia-Ukraine war and the other problems that I mentioned earlier. There's another slide here which relates to their optimism in the country's prospects over the next 12 months, and that remains strong. So you're now not talking short term, you're talking, well, it is 1 year, let's say, so over the next year. And you can see the last column, the columns on the last, in each of the panels, you have the banks on the left-hand side and non-banks on the right-hand side. And you can see that actually that remains strong. So if you're thinking of, for instance, how many of these have been, what percentage of banks, responding banks, were optimistic, and you can see it's 90%. That is significant. Moving on to the next survey is the hotel survey, and again, this is just elements from the surveys, and the surveys will be put out in the next couple of days, and you can look at the detailed results there. But the hotel surveys show the following. First, all the hotels that we surveyed have, or responding hotels were open. And I think also we appreciate that there are some others that are about to open. For instance, the Radisson Blu in Nairobi will be opening shortly, I believe April, May, around that time zone or time band. And also what used to be called the Norfolk Hotel will probably be opened again around the same sort of time. So these are significant, let's say, hotels that are now coming back on stream. There are still some that are closed. We talked about the former Intercontinental, etc. But I think the point here is that in terms of availability of space or hotels, beds, etc., that is significant. Then in terms of, this is a slide that talks about employment, and I think the point here is that that has, relative to pre-COVID, it's edging up. So we're in the 80s, 80% as it were, 80 plus. But I think the point here is there's still some ways to go. And I think also in terms of composition, casuals versus permanent, that is obviously a concern. I think the hotels need to get to a space that they feel confident that they can take on people on a permanent basis, of which they are already doing. And I think it is to good effect. Then the forward bookings, I think that's the next slide. And you can see for May, well, I think the slide is sort of self-explanatory with one caveat, which is the footnote, that many hotels depend on walk-in clients. And this is particularly for us Kenyans, right? So decisions are made very much at the last minute or the last day, which is probably not very fulfilling, but anyway, so be it. But I think the point here is that these numbers are better than, say, what we had seen before. We'll see how this relates to the final outcomes, for instance, in April. I'm talking of, in April we have the Easter holidays, and so maybe those numbers will still be pushed up by those walk-in clients. So those are the points I wanted to make. There are other slides, but I think all those other slides, you can see them in the, we'll put them out in the regular package when they are published. All right. I wanted to say a few things before finishing. I know I have really been talking for a long time. I'm sorry about that. So I want to say a few things first on the banking sector. And I think here we make the point that it is stable and resilient, adequate capital, liquidity, etc., as at end 2022. Now, the issue here is that credit risk remains a concern. This has been the case right from the beginning of COVID, but even a little before that. Credit risk has been a concern and has been with us all this time. And I think we reported, for instance, the NPLs as a ratio of gross loans. And this actually now stands at 14%, as indicated in the press release. And this is really the increase from, let's say, 13.1 that we reported in December. Really relates to about 40 billion Kenya shillings in terms of the facilities that or the loans that led to that increase in that ratio, and relate to something like 16 accounts or 16 loans. So they are not. The point to make is this is not systemic across the sectors, or for that matter, even in a particular sector like manufacturing. It is true there are a few of those loans that were in the manufacturing sector, but manufacturing has continued to perform very well. But for this specific, let's say, institution that had borrowed because of issues that are specific to them, those loans have now been classified as NPLs. I think it is important to also make the point, and this is a point that we remind you, that to compare NPL ratios across countries isn't always, let's say, an appropriate comparison. Why? Because during this time, the COVID period, in some jurisdictions, they actually did, let's say, there was a bit of forbearance, quote unquote. And therefore, the NPLs did not increase as they should have, because in effect, those non-performing loans were defined as proper loans, so they were not defined as non-performing. I guess that's a detail of cross-country comparisons, but I think we've been very aggressive in terms of the definition, remained with it, and also in terms of making sure that the banks classify the loans correctly. Looking ahead, the issue with banks is clear. The issue now is for banks to begin lending to their specific clients who are in the real sector, and I think, or in the production sectors, and I think this is something that we have mentioned before, and banks have, for the most part, gotten together, and we have approved a lot of their business models and their pricing, and because they need to follow the pricing that we indicated in the context of our banking sector charter, the banking charter that we mentioned. So risk-based pricing, customer centricity, etc. Those are transparency. Those are elements that they need to continue to follow. So I think we are making progress in that direction. We also know that a few banks have actually gotten specific loans that are targeted for the SME sector, and we are looking forward to that as well. I think banks have not just waited. They've talked to, let's say, lenders who are willing to provide those loans at a better rate, more favorable rate for the specific sectors in the SME. I would also say that in terms of the impact of the war, Russian-Ukraine war, on the banking sector, it's negligible to nil. First is the banks didn't have any exposure in those two countries, and now we are talking on the balance sheet side, so in terms of the assets in those countries, meaning through those countries even. And I think in Europe, generally, exposure to Eurozone countries is something like maybe 6.6%, less than 7% of the foreign country exposure as at February 2022. And I think we are okay with that. To finish, I want to make maybe 4 points. The first is we have issued, as you know, a discussion paper on the central bank digital currencies, and that is a paper that is on our website, and I encourage you to send in your views. If you locate it on the website, there's a location that you can actually send whatever views you have. I already talked about it, and there's an interview that is on our website as well, that was done with Julian's interviewed me of NTV, and I think it's also available on YouTube. Then there was the national payment strategy that we issued also in February, March. And this really sets out the vision that we have of the national payments, of that space, the payment space. And it's one that I would recommend you to see. I mean, to actually go and locate it on our website as well. And there are many points there, but I think the one point I would want to emphasize is our vision. And our vision of the national payments space is of a secure, fast, efficient, and collaborative payments system that supports financial inclusion and innovations that benefit Kenyans. So that's our vision, and we encourage all innovators that are in this space to look at it and actually begin to align themselves to the vision and everything else that's discussed there. We also recently, thirdly, started the regulation, or let's say supervision, of the digital credit lenders. And again, the regulations that support that and the law have all been approved and gazetted. So we are now, as I said, we are now in business, and we have asked anyone who is in this space, so-called digital credit lender, to get in touch with us, and the information is also available on our website how to do that. So we are looking forward to moving ahead quickly in this space. Finally, I think we also had recently, yes, it was reported, at least in today's papers, that development with regard to the Democratic Republic of Congo, DRC, and its membership, or moving towards membership in the East African community. And obviously we are looking forward to that progress. And I, for one, am looking forward to welcoming the governor of the Central Bank of the Democratic Republic of Congo into the, let's say, into the Monetary Affairs Committee on behalf of the others, but indeed also as one of us, in that space. However, it is important to note that they have not yet become members. The decisions were made yesterday, and the progress is that they will receive. The summit decided that, first the summit decided to admit DRC as a full member of the EAC. And our president, as the chairperson of the summit, will sign the treaty of accession of the DRC into the EAC by April 14. So once that is signed and it is then transmitted to the country concerned, the DRC, they will ratify the treaty of accession. So that is important, ratification. And then after ratification, deposit the instruments of ratification with the EAC Secretary General before September 29, 2022. Obviously, they can do it much sooner. And I think everybody is encouraging them to process the ratification quickly. And we look forward to welcoming them, as I said. Obviously, it is important for us, all of us in Africa, and indeed the East African community, because this is a large economy and also large population of about 92 million people, and of course has a lot of resources, has many challenges like we all do, and I think the idea of strengthening the regional contacts, as it were, the regional connections, is something that is obviously important for ourselves. So thank you very much. I have been speaking for an hour, and now I'm open to your questions.
Thank you very much, Governor. That was the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge, giving the background to the Monetary Policy Committee meeting that was held yesterday, and also a lot more data and information. We'll now jump straight through to the questions that are coming through from you. And as a reminder, please make sure you give us your name and your institution as you ask your question. So from this batch, the first one is from Antoinetta Rusi of the Financial Times. Antoinetta asks, what is your view of the West's sanctions against Russia, given they are hurting the Kenyan economy? Is this a new Cold War? Are they as bad as each other? Razia Khan, who's a chief economist for the Africa and the Middle East at Standard Chartered, has two questions. The first one, in view of Kenya's medium-term debt redemption profile, what is the optimal FX policy? Despite rising import pressure, KE, that is Kenya, has weathered this well. The second question from Razia, what is a CBK's expectation on the continuity of fuel price subsidies in helping to curb current pressures associated with imported oil?
Okay, thank you. So the first question, thank you. So the first question from Antonella, I think in this, I think I wouldn't want to, I can only talk about the economics. So let's stick to the economics. We do understand the reason for the sanctions is not economics, meaning it is the bigger issue to ensure that Russia refrains and indeed withdraws from Ukraine. That is the reason for what they are doing. But I think the point is that, yes, we are hurting. But I think we should also accept that it is nowhere near the pain that the Ukrainian people are facing. And I think this is something we've seen in our own region. And so I think the point that there is sort of spillover damage on our economies, we have to brace and appreciate that it's a small price to pay for what is much more significant for the Ukrainian people, for the, I guess, the people of all of us, all of us global citizens. So we leave that. In terms of whether it's a Cold War, etc., I think those I would rather leave for the political commentators. The question about debt redemption profile, I think, Razia, you're asking how does that relate to the optimal FX policy. I think the FX policy for us, as we have it, has really served Kenya well. I want to stress that, meaning it has allowed us, to sort of accommodate the shocks, the real shocks that come to us, let's say terms of trade shocks. And I think that is something that we have seen through the COVID period, and something that we'll continue to see going forward. It's amazing that something as much as that obviously looks risky, always looks risky, can be that beneficial. So our foreign exchange policy has really been beneficial to us. On the other hand, in terms of debt profile, etc., currently we have particular debt, so we can only, in a particular composition, currency composition, etc. But I think looking forward, one can argue that we need to be more careful about the composition of our external debt. And I think the point here is the currency composition is something that we need to be more careful about, aligning it, for instance, closer to, let's say, our exports, let's say the currency with which we get our exports, so perhaps even picking up a few more euro-denominated debt, etc. But it isn't just something for now. It is something that we need to do going forward because, as you know, even pricing those markets are not working well. So let's not only look at the currency element, but rather overall, let's say, issues with regard to debt profile. And yes, on rising import pressure, it's true. And this is particularly on the, I think Kenya has weathered well. Your assessment is right. And we expect that we'll continue to weather that well because we can see where the pressures are coming from and we know how to deal with that. Fuel subsidies, I think in Kenya, we do expect that to remain. But I think importantly, it may not be at 100%. There may be a sort of an adjustment. So we are not saying that there'll never be any adjustment. There may be adjustment that puts some burden on consumers. But we do expect that there will be a significant burden that is picked up by the government through the fuel price subsidies. Two things to mention there. It has to be short-term. It cannot be long-term. And we have seen how some countries can get caught up in this and be unable to remove it in the long term. And I think the issue there has to be, we are looking forward to the actions by the advanced economies to lower those prices down. I mean, prices at $100 a barrel are completely, beyond the realm of understanding. So I think the point here is the actions that they can do will be beneficial, and that will allow us to withdraw the subsidies at the right time. So that's all I would want to say. But obviously, you appreciate that subsidy, this issue of subsidy, even as it is, and it impacts on prices and inflation, is something that is more of a fiscal issue, fiscal concern or fiscal question.
The second batch of questions will begin with David Herbling from Bloomberg News. David asks, what will be the impact in percentage points of the recent fuel price increase on March inflation? From Kefa Moirori of Citizen Digital, by how much will the renewed global volatility or cost pressures affect your GDP growth projection for 2022, currently at 5.9% as per the presentation? And the third question from Jimmy Mbogo of Business Hour. How is a move by Russia to require that oil transactions be done in Russian rubles going to affect the foreign exchange market in Kenya?
So first, in terms of David Heblin's question, I don't have the precise numbers in terms of in percentage points, but I would encourage you to calculate it yourself. So that is that. In terms of Kefa's question, the volatility, again, as I said, our growth projection has not changed from what we had before. And I thought I explained why it has not changed. First and foremost is the connection with the Ukraine and indeed Russia. And I made the point that that is actually not significant. They are not significant trading partners for us. So I don't think there'll be, you can say that the GDP growth projections will deviate dramatically from that. Of course, the indirect impact is through global growth. So a sort of a scaling back of global growth will obviously affect us. But I think the point here is we had already seen that in the context of COVID-19. And I think it wasn't as significant. So let's keep it at, and that's why we kept it at 5.9. And as we go forward, we'll update our projections. Jimmy's question about oil and paying for oil in Russian rubles. I think the point here is that first we don't buy oil from Russia, so that's that. But I think it points to a risk in the financial markets, or let's say in the global trade markets, where actually transactions, there's some sort of, let's say, breaking up of the frameworks that were there before. And I think what this will do is that in the long run, it will probably just mean there'll be more currencies that will be used for trades, and the dominance of the US dollar will decline. But I think that is a it may happen maybe with regard to the trades that are there between Russia and Europe and etc., particularly on the oil, but also on the gas, etc. But it's not a foregone conclusion that that will happen, though. And even if it happens, we don't expect a complete change in that space, let's say a sea change in the near future. So, but for us, the FX market, no, that won't have any impact on our FX market.
From Constant Munda of the Business Daily, what is the progress in the journey towards positioning Kenya as a premier green finance hub under the CBK guideline on climate-related risk management? Jimmy Mbogo again, what is the status of the EAC regional currency, and is this going to be affected by the CBK digital currency? And lastly, from Charles Moniki of the Business Daily, how many banks have had their risk-based lending models approved so far?
Okay. So in terms of the first question, Constant, I think here I can only say that we are making progress with the specific institutions, in this case banks. One of the things we have had to do is to get into to do a lot of training, and this has been going on very well at all levels. Began with the CEOs and then worked our way into the various sort of managers, etc. We need to appreciate that this is not sort of a quick outcome or low-hanging fruit sort of scenario. It is something that requires effort, requires constancy. I like the ring of, I'm sure you like the ring of that, Constant. So constancy, and eventually we'll get the fruits of this. Of course, there are also other things. There are two institutions. Well, first, the sovereign. There is discussion about issuing a green bond. That has been around for some time, but I think it's something that will happen eventually. I cannot tell you when, but it will eventually happen for sure. And then, of course, there's another bank. There's a bank, and indeed, this is KCB Bank, that is also thinking of going into the green bond, issuing a green bond. I think the issue here is not the issuance per se. That is the easy part. The harder part is working with the investors, meaning like in the case of KCB, they're using that money for investment in green projects, etc. And I hope you appreciate that we are not just thinking, large wind turbines. No, there are many other projects that we need to put together to make them sort of an appropriate package. Status of EAC regional currency, that hasn't changed. We issued a press release, I guess, about a month ago, a little less than a month ago, after the meeting on the Monetary Affairs Committee. I chaired that meeting, and we gave a status report on this. But the point is that your question is, will this affect the CBK digital currency? I don't know. If you have a question, please throw it in there. I think this is a good question. Ask that question. I don't want to be the one that's giving answers. It is you. It is you who should be telling me what your concerns are. Moniki's question about how many banks, I cannot tell you the number. I can only tell you that we've made very good progress on these risk-based lending models. And again, those banks that we haven't, let's say, cleared their model, their lending models, business models, we'll work with them. We are working with them. And for them to actually come up with a proper, something that is fit for purpose.
Thank you, and that is it from the question and answer session. This press conference, as we told you, and is the one that you usually expect coming after the Monetary Policy Committee meeting. So we shall expect another press conference after the next Monetary Policy Committee meeting that at this moment is scheduled for May, but as a press release says, the MPC may meet at any point if the circumstances call for it. For now, thank you very much for being with us this morning into the afternoon. We thank you, and we shall see you at the next one.